Hey there, fellow investors. Have you ever heard the whispers of undervalued stocks and overvalued stocks echoing through the financial markets? These terms are thrown around a lot, but what do they actually mean? An undervalued stock is like a hidden gem, priced lower than its true worth. It has the potential to shine brightly and deliver impressive returns. On the other hand, an overvalued stock is like a risky bet, priced higher than its fundamentals justify. It's like a bubble waiting to burst. But fear not, my friends, because today, we're going to equip you with the knowledge to navigate this exciting world of stock valuation. We'll demystify complex financial jargon and provide you with the tools to make informed investment decisions. Get ready to unlock the secrets of the market and separate those hidden gems from the risky bets. Remember, investing is a marathon, not a sprint. It requires patience, discipline, and a willingness to learn and adapt. So buckle up, let's dive in. One of the first tools in our valuation arsenal is the price-to-earnings (PE) ratio. This ratio tells us how much investors are willing to pay for every dollar of a company's earnings. Think of it as a measure of how expensive or cheap a stock is relative to its profits. To calculate the PE ratio, you simply divide the current stock price by the company's earnings per share, EPS. For example, if a company's stock is trading at $50 per share and its EPS is $5, its PE ratio would be 10. This means that investors are paying $10 for every $1 of earnings. A high PE ratio could indicate that investors are optimistic about the company's future growth prospects and are willing to pay a premium for its stock. Conversely, a low PE ratio might suggest that the company is undervalued or that investors are not as confident in its future earnings potential. While the PE ratio provides a good starting point for valuation, it doesn't tell the whole story. That's where the PEG ratio comes in. The PEG ratio takes into account a company's earnings growth rate, making it particularly useful for evaluating growth stocks. The PEG ratio is calculated by dividing the PE ratio by the company's expected earnings growth rate. A PEG ratio of 1 is generally considered to be fair value, meaning that the company's growth rate is in line with its PE ratio. A PEG ratio below 1 suggests that the company might be undervalued, while a ratio above 1 indicates that it might be overvalued. For example, let's say that company A has a PE ratio of 20 and an expected earnings growth rate of 10%. Its PEG ratio would be 2. In contrast, company B has a PE ratio of 30 but an expected earnings growth rate of 20%, resulting in a PEG ratio of 1.5. Despite having a higher PE ratio, company B might be considered a better value based on its higher growth rate. Dividends are a share of a company's profits that are paid out to shareholders, typically on a quarterly basis. They can be a great source of passive income for investors, and they can also provide valuable insights into a company's financial health. The dividend yield is a measure of how much a company pays out in dividends relative to its stock price. It is calculated by dividing the annual dividend per share by the current stock price. For example, if a company pays an annual dividend of $2 per share, and its stock is trading at $50 per share, its dividend yield would be 4%. A high dividend yield can be an indication that a company is undervalued or that it has a strong track record of returning value to shareholders. However, it's important to note that high dividend yields can sometimes be a red flag, especially if a company is paying out more in dividends than it is earning. The price-to-book ratio is another useful metric for evaluating stocks. It compares a company's market capitalization to its book value, which is the value of its assets minus its liabilities. In essence, the price-to-book ratio tells you how much investors are willing to pay for every dollar of a company's net assets. To calculate the price-to-book ratio, you divide the company's market cap by its book value. A price-to-book ratio of 1 means that the company's stock is trading at its book value. A ratio below 1 suggests that the company might be undervalued, while a ratio above 1 indicates that it might be overvalued. The price-to-book ratio is particularly useful for valuing companies in asset-heavy industries, such as manufacturing, real estate, and financials. However, it's important to note that the book value of a company's assets might not always reflect their true market value, especially in industries where intangible assets such as brand recognition and intellectual property play a significant role. Section 6. Quick tips for the amateur analyst. Spotting red flags and green lights. Now that we've covered some of the key valuation metrics, let's talk about some quick tips for spotting potential red flags and green lights when analyzing stocks. Red flag: consistently declining revenue and earnings. Green light: strong and consistent revenue and earnings growth. Red flag: high levels of debt. Green light: low debt levels and a strong balance sheet. Red flag: poor management team or a history of ethical issues. Green light: experienced and trustworthy management team with a proven track record. Remember, these are just a few quick tips to get you started. It's crucial to conduct thorough research and consider a wide range of factors before making any investment decisions. Section 7. Case Study. Comparing Apple and Tesla's stock valuations. Let's put our knowledge into practice by comparing the stock valuations of two well-known companies, Apple and Tesla. Apple has a long history of profitability and a massive cash hoard. It also pays a modest dividend. However, its growth rate has slowed in recent years, and its price-to-earnings ratio is relatively high compared to the overall market. Tesla, on the other hand, is a much younger company with a more volatile track record. It has yet to turn a consistent profit, and its price-to-earnings ratio is astronomically high based on its current earnings. However, investors are betting on its potential to disrupt the automotive industry and become a dominant player in the electric vehicle market. This example highlights the importance of considering a company's stage of development, industry dynamics, and future growth prospects when evaluating its stock. Section 8. The importance of independent research. Don't rely on tips from your Uncle Sal. It's tempting to rely on stock tips from friends, family, or even charismatic financial gurus. However, it's essential to remember that these tips are often based on speculation, hearsay, or personal biases. The best way to make informed investment decisions is to conduct your own independent research. Start by reading a company's annual reports, 10-K filings, and other publicly available information. Pay attention to its financial statements, management discussions, and industry trends. Use the valuation metrics and tips we've discussed to form your own conclusions about a company's financial health and growth potential. Don't be afraid to ask questions, challenge assumptions, and seek out different perspectives. The more informed you are, the better equipped you'll be to make sound investment decisions. Section 9. Final thoughts. Navigating the market with confidence. Remember, investing in the stock market involves inherent risks. However, by understanding the fundamentals of stock valuation and developing a disciplined approach to research and analysis, you can significantly increase your chances of success. The key is to stay informed, be patient, and never stop learning. The market is constantly evolving, and so should your investment strategy. So go forth, my fellow investors, and navigate the exciting world of the stock market with confidence. And remember, the only bad investment is the one you don't understand.